I'm delighted to be joined by Chris Baker, International Tax Director, and Josh Reeves, Senior US Tax Consultant from MoreDM, who will be discussing avoiding double taxation as an American living overseas. Thank you very much for joining us, both of you. How are you today?
Thanks very much, Hugo. Thanks for the introduction. It's good to be here.
Before we start, please bear in mind that the information presented is for general educational purposes only, and you should always seek your own personalized financial advice. Chris and Josh will be answering your questions at the end, so please add them in the Q&A box at the foot of your screen throughout. And we'll try to answer them all at the end. I'd say we'll probably answer them in order, so the sooner you ask, the more likely it is we'll have time for. So without further ado, over to you.
Thanks, Hugo. Just give me a moment while I jump the screen up. So today we're going to be going over, Chris and myself, understanding the double taxation as a US citizen. So a little bit about MoreDM. We've got kind of 5 presences in the US spread across different states. We've got our London office where myself and Chris are based, and we've got our Zurich, Switzerland office. We provide US advisory and compliance services for individuals, corporations, trusts, and estates. So today's agenda, we'll go through these key points, which typically come up most when we're talking to clients about avoiding double taxation. So we'll kick straight in with US tax credits. So what constitutes a foreign tax credit? So there's 4 key elements that must be met for a foreign tax credit to qualify on a US tax return. Firstly, the tax must be imposed on you. You must have paid or accrued the tax. The tax must be a legal or actual foreign tax liability. And then lastly, the tax must be an income tax or a tax in lieu of income. There are a few specific exclusions from foreign taxes, which include taxes on excluded income and taxes for which you can only take as an itemized deduction. So foreign tax credits on a US tax return, they're split into 7 baskets. Most commonly, we see the general limitations basket and the passive basket. All baskets are clearly stated on what income qualifies for that basket. And if there is an income type that doesn't fit within one of these baskets, it's catched by the general limitations basket. So as an example, passive basket will catch typically passive income, which is dividends, interest, royalties, rents, and general limitations will include things like wages or income that doesn't fall into other categories as mentioned.
And it's important to note here that when we're looking at the foreign tax credit, we're looking at the US domestic legislation. So this is the first most likely solution to any US citizen who is also subject to tax in another country. So there's no treaties, there's no debate. These rules are enshrined in the Internal Revenue Code. So it's always what we're looking at, and it's a crucial part of anything we're doing for Americans with expatriate tax issues. So we're focusing on the foreign tax credit because it is the biggest piece. It's again, we're speaking from the UK. So the UK is a high tax jurisdiction relative to the US. So we kind of get carried away by the fact that there will be enough foreign tax to cover the US tax. There's lots of instances where there might be a US liability, but as a general rule, if income is being doubly taxed and you're a UK resident, then you're unlikely to have a US liability. It's a very broad generalization, but that's kind of where we're looking at it. And then when we speak to our colleagues in Zurich, the opposite is true. The Swiss tax is generally going to be lower than the US. So a lot of those guys do have US tax liabilities. And so it's always dictated by what country you're in. For a Brit who decides to go and spend 2 years in Dubai and pays no tax at all, that's quite appealing. For an American who goes to Dubai, they haven't got any foreign tax credit because they're paying no Dubai tax. So the US are going to take a piece of that. And that's exactly a situation where you aren't faced with double taxation. So in lower tax jurisdictions, and we will go on to it in a little more detail, but this slide looks at where the two come together. The foreign earned income exclusion is very valuable for US persons who live in lower tax jurisdictions. Those in sort of mainland Europe, higher tax jurisdictions, the foreign tax credit is normally going to solve a lot of the double tax issues on its own. So again, speaking with our colleagues in Switzerland, over in the UK, it is unusual for us to see people claiming the foreign earned income exclusion. Again, talking broadly, but you know, we make a campaign of revoking the exclusion. Again, we'll touch on that a little later. But we often will revoke the exclusion for individuals in the UK, and that is all about maximizing the foreign tax credit position. So it really is just a numbers game. But if you have excluded foreign earnings from US tax using the foreign earned income exclusion, you also have to exclude the foreign tax on the excluded income. If the foreign tax is at a higher rate than the US tax on that same income, you're losing foreign tax credits that might otherwise be available to carry forward. So someone in a high tax jurisdiction rely on the foreign tax credit. Someone in a low tax jurisdiction, the foreign earned income exclusion is perhaps all they have to rely on. And again, this is another area that discussions with our Swiss office come up with very different answers to what we're used to in London. When you claim the foreign tax credit, there are two bases available to you to claim the credit. Again, there's kind of self-explanatory in name. You either claim the credit when you pay the foreign tax. So that we're used to in the UK, that gives you a certain flexibility. If you can ensure that you're paying your foreign tax in the right calendar year, you can be sure that you're getting the credit where you need it when the US is taxing that income. So that the pay basis gives that flexibility. The accrued basis, and again, the IRS have sort of firmed up their position on this, but the accrual date for claiming a credit is the end of the foreign tax year ending in the US calendar year tax year. And that's why in the UK it's problematic, because the UK has the 5 April year end. So most of the rest of the world feel the calendar year is a sensible period to be assessing. So the foreign tax year will match the US tax year. In that instance, the accrued basis is actually the easier one to claim. Not least because in a lot of countries, we certainly see Switzerland a lot, we deal with Sweden to some extent. The actual tax for the tax year can be paid getting on for 2 years after that year finished. So by claiming the accrued basis, you're getting that credit 2 years sooner than if you were on a paid basis. And what you're always looking to achieve is to have the credit falling in the right year on the US return. you want your foreign tax falling in the same year as the income that the US is taxing, because that's how you can optimize the offset between the foreign tax and the US liability. The main issue we have with the accrued basis is once you've elected it, and it is by election, so the paid basis, the cash basis is the default position. You can elect the accrued basis. Once you've made that election, you cannot go back to the paid basis. You are on the accrued basis for life, other than that little point down the bottom that says with permission of the IRS. That means getting a private letter ruling, and that costs a lot of money, probably a couple of $1,000s, and that's just the IRS fee, not the professionals for helping you do it. So you do get stuck with the accrued basis, and can create problems in the UK because of the 5th of April tax year. The other issue we have is where you've built up excess foreign tax credits, because broadly speaking, you've got a 45% rate in the UK, 30% rate in the US. The US are only letting you have 30% of the foreign tax as a credit in a year. You can offset the US tax on your foreign income, but it doesn't create a refund. So you get left with that excess, that 15 difference between the 45 and the 30. You get left with that as an excess, and the IRS allows you within the specific baskets that Josh has elucidated on. Within the basket, you can carry forward the excess foreign tax credits up to 10 years, and then they're lost. So the 10 years is actually relatively generous by IRS standards. It allows for a certain amount of planning. It allows for that individual who's gone to Dubai for 2 years, if they built up a pot of excess foreign tax credits in the time they're working in the UK, they can go to Dubai and they can use those carry forward credits to offset the US tax they'd otherwise have to pay. Because it's earned income, it's in the general basket. If the excess is in the right place, then you get the benefit of it. And it does allow for a number of other planning opportunities. When that 10-year carry forward was introduced, replaced the previous 5-year carryback rules, you used to be able to carry back your foreign tax credits 2 years. But when the 10 carry forward came in, the 2 carry back was replaced by a 1-year carryback. So if there's a mismatch on when you're paying or accruing your foreign tax credit, it's quite difficult to solve that problem when you've only got a 1-year carryback. So that's something to bear in mind. The carry forward is generous. The 1-year carryback can create problems and lead to real double tax.
So moving on to the foreign earned income exclusion and housing exclusion, as Chris mentioned previously. So the foreign earned income exclusion and housing exclusion is typically beneficial for a taxpayer who has got earned income, which we'll go over kind of what categorizes as earned income in the next slide, in a foreign jurisdiction. Now, for a taxpayer, they can currently exclude on their current 2022 return up to $112,000. That's increasing to $120,000 for the 2023 tax year. A taxpayer may also deduct or exclude foreign housing costs above the floor of $17,920. That's for the 2022 tax year. And in order to qualify for the exclusions, the taxpayer must meet both of the following. So firstly, they must have a tax home in the foreign country. And secondly, they must meet one of the 2 tests. So the bona fide residency test, or the BFR, is a US citizen or resident alien with a bona fide residence in a foreign country for the full calendar year, or B is the physical presence test. Now, that's a US citizen or US resident who has been physically present in the foreign country for at least 330 full days during the period of 12 consecutive months. So if this is elected to be claimed, it's to be claimed every year going forward. And if in a certain tax year, a taxpayer decides they want to revoke that and stop claiming it, then they cannot claim it again in another tax year for another 5 years. So if there is an instance when a taxpayer is looking to revoke it, it's good to do some forward planning and ensure that they're not going to expect to need to use that in the next 5 tax years. So classification of what falls into earned income or foreign earned income would be all of the following, but typically what we most often see is wages. And what's good to note here is this relates to income earned in a year. So if a taxpayer has a bonus paid in the year that relates to a prior year, unfortunately that won't be able to be excluded using the foreign earned income exclusion. Okay, so these are foreign earned income items that are typically not included, which, as I mentioned, is the bonus that attributes to work in the US in a prior year, earnings relating to work performed within the US while the taxpayer has a foreign tax home is not considered foreign earned income, nor are earnings from the work performed abroad when the taxpayer has a US tax home.
So this is just a little more on the 2 qualifying tests. So I've got in trouble before for saying that the tax home is a fairly clear-cut statement, because there are rules and there are court cases that have looked at that in more detail. But essentially, if you establish that you're paying tax in a foreign country, if it's your place of business is most easily defined, then you'll have a tax home in a foreign country. So here we're looking at the BFR and the PPT, the 2 tests that allow you to claim the foreign earned income exclusion, the foreign housing exclusion as well. So the bona fide residence test, you have to have that foreign tax home and an abode abroad, which again I'll touch on, but it has to be for a full calendar year for you to qualify. And it's not available to green card holders, but they can rely on the physical presence test. But it's not allowed to green card holders unless they're in a treaty country, but the physical presence test is available. So the physical presence test is 330 days in a 12 consecutive month period. We've got a couple of examples on the following slide that will illustrate that a little more, but there's more flexibility with the physical presence test because you don't have to be out for a full calendar year. You can move the qualifying period around. So the bona fide residence test, it does say right there in the middle that you can have part year pro rata. So if you move and get a tax home abroad, have an abode in a foreign country, and you do that on, say, the 1st of July of a calendar year, then once you have qualified under BFR, you could claim half of the exclusion because you had the tax home abroad for half of the year. But you actually have to wait until you've had a full calendar year in that foreign country before you can make the claim for the exclusion under the bona fide residence test. So there is actually a specific IRS extension available, which I'm pretty sure is the 2350. That gets you an extension to the 15th of January following the original 15th of April filing date for your tax return. So that gets you through the whole of that calendar year, allows you to wait to qualify under the bona fide resident test. You can then file your tax return for, by that point, what was 2 calendar years ago. So you're an extended 2022 return, you'd look to get an extension to the 15th of January 2024, over and above this coming around all too quick 15th of April 2023 deadline that is the original filing date. So you can push it back and extend to wait to qualify under BFR. As always with extensions, that's an extension of time to file, not to pay. So in this era we've now entered of higher interest rates, getting those payments in April is going to be more important than ever, because I think the IRS is charging 6% now on any late payments, just the interest. And when we're counting days, this is more relevant to the physical presence test. So the physical presence test gives you flexibility, the bona fide residence. Once you have established that tax home abroad, then you're qualified. You just have to wait until you've had the tax home abroad for a complete calendar year. The physical presence test gives you flexibility, so your days counting becomes more important. We're talking about 330 days in a foreign country in a 365-day period. So if you've got 36 days in the US in that 12-month period, you don't qualify under the physical presence test. So these day countings becomes quite important. And a full day, that's midnight to midnight. If you're traveling over or through the US, in less than 24 hours, that won't be a US presence day. That's the US transit. The middle point there is foreign country over non-foreign country. That's not counted as a day outside the foreign country. I'm not entirely sure what that example means. I guess you've flown over the Pacific for too long and gone back to Europe. But that's days counting. It's midnight to midnight is what you're looking at. Where are you at the midnight? And here's hopefully some illustration of how the physical present test can extend your period. So in this example here, we're looking at actually arriving in the foreign country, establishing a tax home, having an abode on the 1st of July. In this example, it's 2020. So that would be the start point if you waited to qualify for BFR, for bona fide residence. But because you're looking at a 330-day period in a 365, if for the rest of that following 12 months, so through to July 21 in this example, there's no US days, then you can roll back your start date 35 days. So here we've got a 28th of May start date, and that increases the pro rata of that exclusion amount, the 112 for 2022, 120 for 23. So you're getting a pro rata amount of that exclusion. That's the foreign income you can exclude. Again, in the second example there, you've got a few US days, but it's still not over 35, so you can just slide it back a bit. And we have the same here in the year of departure. Again, this time leaving July 21, we can slide back 35 days. So we're getting a larger pro rata share of the exclusion because the physical presence test allows us to move that period about. Now, once you're on foreign assignment, then the physical presence test will be looking at the calendar year. You want to qualify for a calendar year because then you get the full amount of the exclusion. But in arrival and departure years, you can actually increase your pro rata share. Again, we've mentioned this before because it is something we come across, because over here in the UK, we love revoking the exclusion to maximize those foreign tax credits, but it is something you need to be wary of. You need to understand what your plans are. We will not be very popular tax advisors if we revoke an exclusion and 2 years later our clients off to Singapore, where apparently they're going to pay very little tax, and they've just found out that actually there's $112,000 that they could have excluded from US tax that now they're paying US tax on. So it's that 5-year period. It is very important. Prohibited countries, you probably don't need me to tell you what the prohibited countries are. They're going to be, I think, Mr. Trump's axis of evil. They're going to North Korea, Iran. You're not going to be getting the foreign earned income exclusion. You're not going to qualify if you're residing in one of those countries. And the last point there that they do ask, the form you claim the exclusion on is the 2555. They ask if you have made a statement to the foreign country that you are not resident or if you're not subject to tax there. So if you make that statement, again, it's pretty self-evident. They're not going to let you exclude the income if you are choosing not to pay tax in the foreign jurisdiction. So the foreign earned income exclusion is very valuable for people in a low tax jurisdiction, and it simplifies the tax position for someone earning for 2022 up to $112,000. Their tax return, if all they've got is wages, $100,000 of wages goes on the income, the line 7 of the 1040. If it's that simple, there is a 2555 EZ, which only makes sense with the American pronunciation, that allows you to just put through that negative 100,000. That's the tax return. 100,000 in, 100,000 out, no tax due. That's a simplified tax return. So the exclusion makes that person's tax filing much more straightforward. So what we've talked about so far are rules that exist in the Internal Revenue Code, interpreted through Treasury regulations, and all the other good stuff the IRS publish. Now that's all well and good, but as any US person resident in a foreign country knows, they've got 2 jurisdictions that they have to account for, and those 2 countries won't have sat down together when they wrote their tax legislation, and there's always tricky pieces. There'll be situations where both countries are saying they have a right to tax, and without double tax treaties, those individuals and indeed corporations and what other taxable entity there may be, without the double tax treaty, there are problems. So the kind of the world of the bilateral tax treaty came into being, and the US has negotiated firmly, as you will not be surprised to learn, but has a lot of income tax treaties with a lot of different countries. I mean, they're about trading relationships in the first instance. If you ever punish yourself by reading the kind of negotiations around tax treaties, you'll see that the bulk of the conversation is around corporations. That's really what it's focused on, but it deals with the position for individuals. And that's really the primary reason behind them, to try to prevent double taxation. So they follow a formula really. The US will sort of look at some of the initial articles. The US has its own model tax treaties. The OECD has model tax treaties, and negotiations are based around what the appropriate articles will be. So they're ultimately trying to get to a position where the tax is fairly distributed between the two countries. Whilst they're based on model treaties, they'll all be negotiated at different times. They'll have a year on them. The US UK one, the current one is 2001. So they'll all be slightly different. There'll be particular issues that came up in negotiations. They will just have been drafted at different times when different things were of primary concern. So again, the technical explanation that's mentioned there for the treaties, that's essentially a summary of the negotiations and why they reached the positions they were. So there is more background information when you're trying to interpret a treaty. And these articles are pretty much common, that all of them is where we start off. They're just the scope, what taxes are covered, what individuals, what entities, and yeah, Article 2. And then Article 3 goes through the definitions. There's normally a pretty long article and brings in all the terms used. Well, not necessarily all the terms. Famously, lump sum is never defined in the treaties for the pension article, but you know, that's what's there as a definition. And then Article 4 will deal with residence, and that talks about habitual abode, centre of vital interests. So you know, where you spend your time, where your economic, personal relations are, where within the domestic legislation, and because the US definition of resident is based on citizenship, there will almost always be an argument that under domestic rules, an individual is resident in two countries. So Article 4 of the treaty determines who's a resident. And then most US tax treaties have this catch-all that they stick at the end of Article 1, which is known as the saving clause, where essentially the US reserves the rights to tax its citizens and residents as if the treaty did not apply. Then there follows certain specific exceptions within a treaty, and again, it's treaty by treaty, but there follow specific exceptions, carve-outs from this saving clause. So the saving clause is saying, notwithstanding everything we've agreed here, we're still going to tax you if you're a citizen or resident. Which again, that creates real double tax issues. So here, actually at the top here, it says Article 23, relief from double taxation. That's true of the Swedish tax treaty, which I think our example is taken from. In the UK US treaty, that's Article 24. But there is a long article that tells you how you go about getting relief from double taxation when the US, under the saving clause, has determined it's going to tax its citizens in any case. And again, this takes us back to the foreign tax credits, what we've been relying on throughout. When Josh ran through those baskets earlier, one of them was income resource by treaty. So there is a specific basket within those foreign tax credit categories that is the home for US income that a treaty allows you to pretend is foreign, because that's the mechanism whereby you get relief from the otherwise punitive consequences of that saving clause. So again, just an article here, and this is why we've referenced 23, because the example we pulled up was actually relevant to the Swedish treaty. But this is where the Form 1116, you're looking at the income resource by treaty. So if you have US work days whilst you're on your foreign assignment, the normal treatment would be to source your earnings based on where you perform the duties. Where the resource by treaty is relevant, you take those US work days and you treat it as foreign income. It's in a separate basket because the whole point of the basket is to ensure there are limitations, so you're only getting a credit for the foreign tax you paid on the resourced income. For us and our consultants, the trickiest one is often US dividends, because under tax treaties, again, always start the negotiations with corporations, the US reserves the right to tax dividends from US companies under most of its tax treaties. I would say all, but I can't be 100% certain of that, but it's generally the case, and it's generally you have a treaty rate of 15%. So if you have qualified dividends, the maths isn't so difficult. If you've got ordinary dividends does get a bit trickier, but you resource a portion of the US income into the foreign basket. So you end up with an effective tax rate in the US of 15%, and you're getting a credit against any US tax over and above 15%. Again, the interest is another one that's generally resourced in full under the resourcing provisions. And they're quite a small little version of Form 8833. This is the form you are required to file with a tax return where you're making a treaty claim. Apologies for getting a bit techie there, but there's a regulation quoted that provides a list of treaty positions where you do not have to file an 8833. So if you're not listed in there, then you're taking advantage of a treaty, you need to file this Form 8833.
Okay, so another element that can be quite important for US citizens to think about when understanding double taxation is the estate. Gift and estate tax can come into play quite often, actually. So in terms of the current gift and estate allowance, as it stands right now for 2023, it's 12,922,000. However, that is set to sunset to around about 5 million at the beginning of 2026. So there's a few years left for US citizens to discuss and do some planning perhaps around this.
Yeah, that 5 million's inflation linked. So should we end up sunsetting, it's probably going to come in at around $6.8 million. So that was the 5 million was in the old legislation. It was increased, and unless someone does anything about it, the 12.9 will drop away at the end of 25, and we'll be back to whatever the inflation linked version of 5 million will be, which I think is going to be 6.8 or thereabouts.
Yeah, in the US, there's transfers between US spouses are exempt. So if you are looking to do planning, that's something to consider. The surviving spouse will be able to attribute to any of the remaining gift and estate allowance from their deceased spouse. So it's currently 12.9 million each per spouse. And as I said, if one is to pass, whatever was to be remaining in the deceased spouse would move to the surviving spouse to potentially bring that estate allowance up to almost 26 million, again, set to sunset at the beginning of 2026. Transfers between spouses in the UK. We'll use the UK as an example because we're based in London, but it can vary across different European countries. So always good to consult a US advisor, but specifically for the UK, transfers between spouses are exempt if both of the individuals are UK domiciled. If in the example of spouses, one is UK domiciled and the other is not, there can be some issues that arise. So again, it's always good to do some planning around that. Sticking with the UK, on the UK side, gift tax is not taxable if the donor of the gift survives for at least 7 years or more. If they are to pass within 7 years, the amount of tax kind of is staggered across those 7 years, the threshold. And then with the way that the US interacts with the UK, there is an estate tax treaty in place. And one thing to note here with the US is they have quite a limited list on in terms of which countries they actually have an estate tax treaty with. And so this is the list as it stands. So yeah, it's pretty self-explanatory up on the screen here. These are the countries that the US currently has a gift and estate tax treaty with.
Yeah, so again, there's a world there of double tax exposure if you are resident in a foreign country that is not one of these. So whilst there are a lot of double tax treaties for income tax, it's a limited spectrum here, as you can see, for estate and gift where that is relevant. And then I think as we're coming towards the end of our time speaking to you, we thought, I mean, it's probably a little cheeky to put this one in when we're talking about understanding double tax, but this is essentially dropping the bomb on double tax. I'm bored of having to file returns in 2 countries. I don't want the complexities of dealing with 2 or more jurisdictions. So how do I go about giving up US citizenship? How do I get out of US tax completely? My experience, we see this strange term, accidental Americans. We deal a lot through streamlined process, people who discover they're actually US citizens and that makes them US taxpayers, hadn't understood. They use one of the programs just streamlined available now to get back into the system, comply with all their obligations, and as soon as they're back in the system, then they get out of the system and expatriate. Their voices often sound quite like mine, and real people who grew up in the US, the idea of giving up citizenship is tempting when they get their tax bill, but actually the reality of doing it is quite another matter. And I think it does depend on what embassy you attend, but some of them will give you, quite a grilling in the interview you have to attend to give up citizenship. But it is there, it is an option. It should get you out of double tax. There are some issues with covered expatriates, which we'll kind of look at what that means, but we won't go into any more detail on it. Anyway, the current fee is there. It's $2,350. At some point, because the Department of State have filed this notice of intent, at some point that fee will drop to $450, which is what it was when it was first brought in 2010. Now, this term covered expatriate is important because if you are considered a covered expatriate, then you've got more tax to pay potentially before you get out of the US tax net. So when it comes to expatriating an individual taxpayer, firstly, they must be able to certify under penalties of perjury, as it always is, they are fully compliant with their tax filing obligations for the preceding 5 years. So when an individual wants to expatriate, they have to have filed the last 5 years. Otherwise, they are automatically a covered expatriate and have exit tax considerations. Assuming, certainly with our clients, that if you're going forward with expatriation, you are fully compliant, you've got everything filed, then the two tests that determine if you are covered or not is the average annual net income tax and the net worth test. The average test is inflation adjusted for 2023. That's an average tax liability over a 5-year period of $190,000. Hopefully, a lot of our clients are not going to meet that because they've maximized their foreign tax credits, they've avoided double tax through the years, and they're not going to have that kind of US tax liability. The net worth test, which is not inflation adjusted, is $2 million. If your net worth is over $2 million, then you will be considered a covered expatriate and subject to exit tax provisions. So I think that's all I really need to say on that final opportunity to get out of US tax. And I think it's over to Hugo, and we may have some questions.
Thank you very much, guys. That was excellent. Lots and lots of information there. We have about 10 minutes, so let's dive into some questions. Before we do, just to let our audience know that Chris and Josh will be back in just over 3 hours' time for an hour of just taking questions with some other US expat tax experts as well. So if you don't get your question answered now, there is another opportunity a bit later on. So jumping in at the start, some are very country specific. Let's try. Yeah, okay. So if you're a student, you pay, this is a student in Hungary, pays Hungarian income tax and social security tax. Can he get a credit for social security tax paid to the Hungarian tax authority, and so not have to pay US social security tax too?
Social security is dealt with separately, so it's not covered by income tax treaties, it's covered by totalization agreements. I don't know where Hungary stands on totalization agreements at the moment. We're in the more network, we will have Hungarian colleagues who can help out on those sort of issues, but generally you should only be paying social security in one or other jurisdiction as long as there's a totalization agreement in place.
Thank you. So Nancy says, is the foreign tax credit for any country? Regardless where you live, I think that means.
Yes, broadly speaking, yes. I mean, even if you live in the US, but you have investment income from outside the US, they might not like that. We know PFICs and the like, but if you're paying a foreign tax and that foreign jurisdiction has the right to raise that tax, then you should be able to get a credit for it on your US tax return. Probably going to come down to a tax treaty to determine if they do or do not have the right. One of those foreign tax baskets was about high tax withholding income. So certain countries will have a right to withhold at a high level. That income will get shifted into a separate basket. But yes, as long as it's not a boycotted country, then broadly speaking, if you've got foreign income and you've paid foreign tax, you should get a credit wherever you are living as a US person.
And this one's related really, but if you may have kind of covered it, but just to reiterate, if you have foreign tax credit carry forwards from living in one country, can you use them if you move country?
Yeah, that's absolutely right. It's unusual compared to a lot of other countries. You don't have to link the credit generally to specific income. You put it into specific baskets. So as long as your income is in the same basket as your excess credits, then it doesn't matter how you acquire those credits. So as I mentioned, if you've moved to Dubai, having been working in the UK, just employment income. The employment income from both is general basket. That excess gets used up, no problems.
Another foreign tax credit question. Is it true that taking the foreign tax credit doesn't prevent you from making a Roth IRA contribution?
Actually, I remembering the ways around with the IRAs, I think that's actually, that optimizes the position, because I think claiming the foreign earned income exclusion reduces your qualifying income. So I think actually IRA contributions are optimized where you claim the credit and not the exclusion.
That's great. How do you report an inherited real estate abroad? How is it taxed in the US? Is it only capital gains while selling the property?
Right. So always the way with US people outside the US, lots of information reporting required, not necessarily tax to pay. The problem is with all of the information returns, the penalties can be quite punitive and they're not tax geared, whereas with the tax return, your penalties are based on the tax you owe. So if you inherit, whether it be real estate or anything else, from a foreign decedent, you have a bequest from a foreign estate that is in excess of $100,000, you have to report it on a form 3520. If you fail to report it, then the IRS can claim penalties as a percentage of the value of the gift. So there's no tax at the point of inheritance, but there is a reporting obligation.
Fantastic, thank you. Paul says, can I claim the foreign housing exclusion without taking the foreign earned income exclusion?
That is a bit of a niche one, but yes, they are separate exclusions, and that might optimize an individual's position, but certainly they are technically under the same bit of code, but they're technically separate elections.
And somebody asks, can you take the foreign tax credit for capital gains taxes?
Again, yes, broadly speaking, yes, you can. There are issues with sourcing with capital gains. Under the Internal Revenue Code, if you are paying less than a 10% foreign tax, then that capital gain on personal property, not real property, not business property, so sale of shares, that capital gain will be US sourced unless you are paying over 10% foreign tax. So there are complexities around the capital gains, and the UK capital gains rate on personal property would be 20%, same as the US long-term capital gain rate, but that would put it in the passive basket. So you're in a separate basket, but the US long-term rate to the UK regular capital gains rate, the straight offset. The net investment income tax, the 3.8% on top, that's a real tax to a US person because it's a social security charge, not an income tax. So there's no relief for that.
Okay. Gregory says, can you claim the foreign tax credit above the foreign earned income exclusion threshold?
Yes, absolutely. So to the extent you've excluded the income, you reduce the amount of foreign tax credit you have that you're allowed to claim that year. The proportions should work out. So if you've claimed 100,000 exclusion against 200,000 of foreign earned income, 100,000 of that is taken out of tax, but the foreign tax you paid on the other 100,000, you're getting a credit for that on your 1116.
I was just thinking, why would you do that rather than just take the foreign tax credit, though? Is it sometimes advantageous, or? It's
all about the tax rate in the foreign country. That determines it. If you're in the UK, you're paying 45%, then you're better off just claiming the credit. But if you were in Switzerland before, So most of the clients in our Zurich office, that A, they're on the accrued basis for foreign tax credits, and B, they're claiming the foreign earned income exclusion. Then they move here and we go, why did you put that guy on the accrued basis? And can we revoke this exclusion? Because, so if they're going to be in the UK for 5 years, we'll revoke it, but we need to be comfortable they're not moving to Hong Kong in 2 years' time. That's the thought process you have to go through. And just, frown at your Swiss colleagues for putting you in an awkward position when the client comes over here.
Okay, UK specific one from Teresa. How does the saving clause apply to the UK-US, to a UK-US dual citizen living in the UK with UK and US private pensions and UK and US state pensions? I think that may apply to the tax treaty in general and the UK tax.
Yeah, but those items. So again, we're running low on time, but pensions happily are one. Not all of it. So Article 17 is the pensions article. Portions of Article 17 are the ones that are exempted from the saving clause clawback. So actually, pensions can get out of that. And if you can't get out of the saving clause, then you're into that relief from double taxation, Article 24, and then you're into resourcing income. But for Tracer, the pensions are probably going to be okay. You can ignore the saving clause.
Well, let's just do one more for now.
You can't ignore it. You're exempt from it. Sorry. Don't ignore it.
So just one last question then. I'm a US citizen living in Austria. When I pass, which country will determine the estate or inheritance tax? I suppose that could apply to any country though.
A US citizen, was that, Hugo?
Yes.
Yeah, so I'm pretty sure Austria was on the list, so that's a happy result for the estate tax treaty. But I would, under general principles, without any Austrian expertise, say Austria would have the primary right and there'll be a residual right in the US. What you get with the UK, and I don't know at all with Austria, the nil rate ban in the UK is just £325,000. The US, you've got $12.9 million. It's the country that is not the US that is generally the issue for estate or inheritance tax.